And now introducing Mr. Keith Lanton.
Good morning. Today is Monday, December 12th, almost halfway through the month of December. I'm lucky enough to be in warm Houston, Texas, visiting our office down here. Hope everyone had a great weekend and is looking forward to closing out the last few months, or a few weeks, I should say, or a few days of 2022. So this morning, I'm going to share some thoughts from James Clear, the author of Atomic Habits. Give some thoughts on financial markets and what we as investors should be focusing on here at year end. And then we'll take a look at what's going on in financial markets this morning and review some of the articles and thoughts in Barron's. So here we are, year-end thoughts, and inevitably the milestone of December 31st and January 1 often lead us to look back as a milestone on what took place the previous year and perhaps to a larger extent focus on what we'd like to accomplish in the following year in 2023. So I'll give some thoughts on that. Start with a quote from Lucy Mallory on the power of thoughts and how perhaps we can incorporate this into our thinking as we approach what we want to accomplish going forward. Every thought a person dwells upon, whether he expresses it or not, either damages or improves his or her life. And I'm thinking about what we do every day, what our attitude towards what we're doing every single day, whether it's at work or working on relationships, things that are meaningful to us. Some things that we do are a job, others are a craft. The primary difference between the job and the craft is not the task, but the enthusiasm and curiosity put into a task. The more engaged and interested you are in anything, the more it becomes a craft and not a job. I'm thinking about resetting for 2023. Think about it. It only takes 5 minutes to break a cycle that you're not happy with, something you want to change. 5 minutes of exercise and you're back on the path. 5 minutes of writing and the manuscript is moving forward again. 5 minutes of conversation and the relationship is restored. It doesn't take much to feel good again and to turn things around. And when thinking about turning things around, many of us say to ourselves, I can't accomplish that particular task or that particular challenge on my own. I have to wait for others. After all, nobody accomplishes anything significant alone, and that's true. But nobody accomplishes anything significant by accident either. Just because you need others doesn't mean you can wait for others to make it happen. You have to act as if you are a force of nature and try to bend the universe in your desired direction while remaining pleasant and open to help along the way. So, 19 days left in 2022. Many people are ready to just coast to the finish line, but these final 2 weeks, these final 19 days can make the whole year feel like a success. So I'll leave you with this thought. What can you do in the next 19 days to build momentum and finish the year on a high note? So moving to investments, and speaking of year end, some things that we can all be thinking about, some of which we've talked about previously. Number one is tax strategizing. Can you take any actions that will entitle you to a loss of $3,000? Perhaps there's some other strategies you want to engage in with gains and losses in your portfolio to reset your portfolio. It's a good time to think about charitable giving. This may be a time of year to establish a donor-advised fund so that you can contribute a lot to charity. Perhaps you've been fortunate and had a very good year and you want to reduce your tax liability. Think about making your 529 contributions. You may be entitled to a tax deduction for those contributions. For those who are 72 years of age or older, you need to take required minimum distributions. Perhaps you've inherited an IRA. You've got to take those distributions. Think about what it is that you have learned this year and what you will do to affect change in the future based on what you've learned this year. So this is a time to reassess where you are in your life and do circumstances, have they changed significantly enough that you should be making changes to your investment portfolio as you look back on this year. Perhaps you learned more about yourself and you realized that you had invested heavily in crypto or in certain technology stocks that had a significant decline, and you feel like you took on more risk than you realized you did, and you are comfortable with. Perhaps this is an opportunity to learn from that situation and do things differently in the future. Perhaps you want to rethink your risk tolerance. Maybe you want to take more risk, want to take less risk. This is an opportunity to perhaps rebalance your portfolio. If you're comfortable with the way your investments were allocated this year, you may still want to rebalance based on the movements in the stock and bond and commodity markets. And finally, you may want to reset your goals going into 2023, both financial, personal, and professional, based on all the inputs that you received in 2022. So, financial markets this morning, where are we? We are at the crossroads once again. We are in a tug of war right now between possibly going into a recession. 61% of economists, CNBC reported this morning, think that a recession sometime in 2023 is likely. So more folks there expecting recession than not. And this crowd that's concerned has many factors in their tool belt that they are thinking about that perhaps is worrying them about the economy and the possibility of recession. So those folks are thinking about inflation being too high. They're thinking about growth slowing down. They're thinking about the war between Russia and Ukraine and all of the factors that's causing as an offset in other avenues of economic growth. They're thinking about the tight labor market, the inverted yield curve, the slowdown in the world population growth, trends towards onshoring, the tension between the U.S. and China and Taiwan, and now we're concerned about will Congress decide to fund the government. On the flip side, there are the folks who are more optimistic, and those are those who think perhaps we will see a soft landing, or perhaps those who think we won't necessarily see a soft landing, but enough of the bad news is priced in that the landing won't be too bumpy. It won't be soft, but it won't be too bumpy. And the bad news has been priced into the financial markets already this year. Those folks are thinking that the Federal Reserve will go slower on interest rate hikes, perhaps will even in late 2023 or early 2024 think about reducing interest rates. They think that the labor market, while showing some minimal signs of slowing down, it's still very strong, and there's lots of strength for workers to continue to earn meaningful pay. Those folks are suggesting that there was a lot of money distributed in the pandemic, and there's still a lot of funds in bank accounts that leave some dry powder for folks to go out and travel and buy goods and services. And companies are seeing religion now, and are focusing more on profitability and efficiency and not necessarily on clicks and eyeballs. And all of us are experiencing that gasoline prices as a result of lower oil and natural gas prices are coming down, and those are positives for all of us who are trying to earn as much as we can and save as much as possible. So, where does that leave us? Where are we this morning? We're modestly higher in the equity market. Dow futures are up about 67 points. S&P futures are up about 10, and NASDAQ futures are up about 27 points above fair value. In the bond market, we're seeing yields down modestly. The 10-year is at a 3.54. In fact, sovereign bond yields pretty much throughout the world this morning are modestly lower than they were the day before. So, coming off of last week's market, last week's losses, we do see this modest move higher. There is some M&A news this morning and some bargain hunting pursuits after last week's large losses, which is helping to prop things up somewhat this morning. Still, there is some hesitation in the market as market participants await the November Consumer Price Index, which comes out tomorrow at 8:30 Eastern Time. Followed by the Federal Reserve's decision on interest rates on Wednesday. In addition to the Fed's meeting, the European Central Bank and the Bank of England will announce policy decisions on Thursday. Bloomberg is reporting that COVID cases are spreading rapidly through China, but the government is continuing to ease its zero COVID policy. In some corporate news this morning, Microsoft announced a 10-year strategic partnership with the London Stock Exchange. Microsoft will purchase approximately 4% equity stake in the London Stock Exchange group. Spirit Airlines this morning, down modestly. They have offered a 43% raise to pilots over the next 2 years. Just to give you an idea of some of the pricing power of the pilots having some pressure on wages as we see strong demand for pilots. Rivian Automotive announced that they have paused a partnership discussion with Mercedes-Benz on electric van production in Europe. That stock's down about 2.5%. Horizon Pharmaceuticals, Hotel Zebra, Nancy Papa is up 15% this morning. Amgen has confirmed it will acquire HCNP for $116.50 per share in cash. Weber, WEBR, which had gone public about a year or two ago, and the stock had never really had any meaningful appreciation, is going to be taken private once again, this time by a private equity firm, BDT Capital Partners, for $8 per share in that transaction. A couple of analyst comments. The Gap, GPS, and Box BOX both upgraded this morning. Gap upgraded to buy from neutral at Goldman Sachs, and Box upgraded to overweight from neutral at JP Morgan. Overseas, equity markets in the Asia region began the week on a lower note, with markets in China feeling pressure from property and bank names. The Hang Seng down a little over 2%, the Shanghai down about 1%, the Nikkei was down 0.2%. In Europe, we are seeing modest losses there as well. Financial markets in Europe down roughly 0.5%. Bloomberg reporting that China's medical advisor says that the Omicron risks are the same as the flu. Wall Street Journal reporting that Congress will resume negotiations on government funding ahead of Friday's deadline. The two sides have differences over $26 billion in non-defense spending and IRS funding. Treasury Secretary Yellen was on 60 Minutes and says she believes inflation will be lower in 2023. She said there is a risk of recession, but she said it's not necessary to bring inflation down. Financial Times reporting that investor withdrawals from crypto exchanges hit a record. So moving on to what we have to look forward to this week. We talked about tomorrow. We have the Consumer Price Index being released, and all eyes will be on the CPI after a hotter than expected PPI on Friday. The CPI is forecast to show a 7.3% year-over-year jump following a 7.7% jump in October. The core is expected to show an increase of 6.1%. The core excludes volatile food and energy prices, and that would be down from 6.3% in October. Also, tomorrow, the House Financial Services Committee meets for its initial hearing investigating the collapse of FTX, the cryptocurrency exchange. FTX founder Sam Bankman-Fried told the Wall Street Journal that he plans on offering testimony at that hearing. Later today, Oracle reports earnings. Analysts are looking for $1.17 per share. Wednesday, of course, the big event of the week, Federal Open Market Committee concludes its two-day meeting of the year. Widely expected the Federal Reserve will increase interest rates 50 basis points, but as is usually the case, all eyes will be on the expectations going forward and what other information the Fed provides to the financial markets along with their decision on interest rates. Later in the week, Thursday, European Central Bank begins its two-day meeting on Thursday with results on Friday. Also on Thursday, we get retail sales for November, and we get November's industrial production figures. So, financial markets. Barron's, the trader column, said the stock market had a terrible week, and now the Fed is on tap. Things tend to slow down for the holidays, but the stock market isn't there yet. This coming week certainly won't be boring with the highly anticipated inflation data, which we just discussed, and the Federal Reserve decision on back-to-back days. These two events will do much to determine the direction of the market for the coming weeks, a deeper slide or a resumption of the Santa Claus rally. All eyes on the November CPI, out, I just said tomorrow morning, expected to show some moderation from last month. In a potential preview, this Friday's PPI showed a continued slowing in the rate of price increases, but not as much as expected. Stock indexes ticked down on Friday after that data came out after an attempt at a rebound fizzled in the afternoon. The S&P closed last week down 3.4%, the Dow was down 2.8%, and the NASDAQ lost just about 4%. So tomorrow, beginning of the Fed meeting, Wednesday we get that decision, and we are looking for the Fed funds rate to be up 50 basis points, and the new range would be 4.25% to 4.5%. Don't be surprised, though, if Powell decides to play the Grinch at Wednesday's press conference, keeping his hawkish tone to temper hopes for a policy pivot. That's doubly true if we get a CPI report on Tuesday that is exciting to the market, meaning it comes in weaker than expected. We get a big bounce in the market. Chairman Powell may want to reduce some of that enthusiasm if we get a CPI number that is weaker than expected. And finally, lots of attention will be paid to the Fed and their so-called dot plot. One of the factors on that dot plot is what the terminal rate on the Fed funds rate will be. In other words, what will be the highest point on the Fed funds rate. Right now, the expectation is that will come in somewhere in the neighborhood of 5.15% is what the market's expecting. So lots of folks will be paying attention to see if there's any change relative to expectations. So Barron's had an article that talked about the recent casualty in the marketplace, previously very hot sector, attracting lots of retail investors, and this is private real estate investments, and the largest private REIT is run by Blackstone. And last week, Blackstone announced that they are reducing liquidity or the ability to sell your shares in their private REIT. The recent move by Blackstone, the real estate fund giant, to limit redemptions after outsized withdrawal requests is a wake-up for investors in the once hot sector that now may face regulatory scrutiny. And this is just another casualty, in my opinion, of rising rates. We saw the meltdown in crypto. We saw the meltdown in many of the technology stocks that were COVID related in terms of the technology that they provide. And now we are seeing some weakness in private REITs. So Blackstone's real estate income trust, known as BREIT, BREIT, wasn't supposed to offer surprises, Barron says. The $69 billion BREIT, the leader among non-traded funds, was a way to get solid returns, a chunky 4% dividend, and the expertise of the world's top commercial real estate investor. In return, investors sacrificed liquidity. They could only withdraw their investments from the fund, which doesn't trade on an exchange, up to 2% of net asset value in a month and 5% for a quarter. And for a long time, it worked. The fund returned 9% this year through October and 13% annually since its inception almost 6 years ago. So it has done extremely well, and it has attracted lots of investors, and they've just attracted $26 billion in new purchases last year alone. But recently, inflows have turned to outflows, and on December 1st, Blackstone made the surprise announcement that it was limiting investor redemptions after requests hit the quarterly limit. That's what's known as gating a fund. Redemption requests rose from $1.8 billion in October to $3 billion in November, forcing Blackstone to prorate and accept only 43% of its redemption requests. Now that the fund is gated, redemptions are likely to probably accelerate as people get wind of this and get concerned that they may not have the access to the funds that they thought they did. And others who are thinking of putting money into the fund may think twice now, given that the gating is more extreme than perhaps that they've previously thought about. So the reversal of flows could be a problem for a private REIT. If you compare a private REIT to a public REIT, Barron says public REITs have permanent capital, but private REITs like BREIT is dependent on investor flows. So if withdrawals continue, the fund might have to sell assets brought in during better days to reduce its already sizable debt load, which stood at $68 billion at the end of September. The reason that there is an incentive for redemptions, according to Barron's, is that BREIT is still up year to date, even after some of the most recent weakness, and public REITs are down about 30% year to date. So what does Barron suggest doing? Barron says that they think that the benefit right now of investing in a private REIT versus a public REIT is just not present, that the public REITs have already sold off. You don't have the risk that there'll be redemptions and that the fund will have to sell real estate in order to meet those redemptions. Therefore, they feel the risk-reward has swung from being perhaps more favorable to private REITs at one point in time to now being a lot more favorable to invest in quality public REITs. Moving on to a different article in Barron's. Barron's had a interview with Felix Zuloff, well-renowned market expert. He runs the Zuloff Consulting Group, and he gave his input to Barron's on what he thought would be the best places to invest in 2023 after being very cautious going into 2022, which proved prescient. He asked, what does he see now in 2023? He says, we see the building of two major blocks, a democratic bloc led by the U.S. and an autocratic bloc led by China. And this means that the period of globalization of the past 30 years, he says, is over. He says he thinks that we deglobalize for perhaps the next 10 years. That means that the world will get less efficient and more inflationary. A safe supply chain will be more important than a cheap supply chain. He also goes on to say that he thinks that the United States made a big mistake when we what he calls weaponized the dollar payment system. This has to do with the sanctions imposed on Russia, and suggesting that any nation that doesn't view themselves as a dear friend of the United States will now think twice before storing their foreign exchange reserves in the U.S. and keeping them in dollars. And what he thinks going forward that many nations will do, he doesn't name them specifically, but like Russia and Saudi Arabia would be examples based on his commentary, is that they may store their wealth not necessarily in other currencies, because there's just not the liquidity and the size of those currencies as there are in U.S. dollars, but he feels that they will try and store their reserves in stuff like hard assets and commodities. And therefore, he feels that commodities for the next few years will be a good place for investors. He also says that with respect to interest rates, he thinks that investors are very focused on the price of money, which is the current interest rates. But he also says that many of us are missing that the quantity of money is another critical factor, and that is sharply declining or decelerating. So the tightening, he suggests, is a lot greater than many of us even recognize. When you look at money aggregates in the U.S. or worldwide, the growth rate is declining sharply. Real M2, which is a measure of the amount of or quantity of liquidity in U.S. markets, has had the most severe decline since World War II. He says that the tightening of money will eventually hurt the economy, and he says that the bond market is ahead of the curve, so to speak, in terms of anticipating the fact that money is a lot tighter than we anticipate, and things will slow down to a much greater extent than many think. And that's why we have an inverted yield curve, where we're seeing 10-year yields as low as 3.5%, and we're seeing Fed funds rate after this week being north of 4% and perhaps climbing as high as 5%. In order to have a 3.5% 10-year yield, that means that somebody thinks that rates are going to be a lot lower sometime in the next couple of years. And he goes on to say that he thinks that 10-year bond yields could decline as much as another 2% from here. And he thinks that there is still a lot of opportunity to invest in bonds for the next couple of years. But then what he thinks beyond the next couple of years, let's say going into 2024, 2025, 2026, he thinks that we're going to see inflation once again because of his thesis that many nations will be investing in commodities, and we will have commodity inflation because of the hoarding or holding of those hard assets instead of dollars. That will be inflationary, and at that point, you will see interest rates move up again very meaningfully. So Bottom line, he thinks you've got to be very nimble moving forward. He thinks rates are going to decline, and then a few years later, they will increase meaningfully. So reason to make sure that your allocations are correct, reason to constantly be reassessing and working with your financial professional to make sure that your portfolio is positioned as markets shift. One final thought before we finish up today's discussion. Barron's had an article about retirees putting their lives on hold. They did it for COVID, and now inflation is forcing them to do it again. Fidelity Investments is reporting that many who had planned to retire this year have decided to keep working as they wait out the storm. One of the biggest pain points for many older Americans is inflation and the fact that their wages are not increasing as rapidly as their costs to live. At the same time, what they're seeing is their 401ks and their savings being diminished by inflation and by a down market. So they're deciding to work longer and perhaps consider, on the positive side, more income-oriented investments as rates have climbed. Bill Bengen, who is the former financial advisor and the father of the so-called 4% withdrawal rule, which suggests that retirees can withdraw about 4% of their portfolio every year once they reach retirement age of 65. Well, he's out saying that given the higher interest rates, that 4% has moved up to 4.7% based on current interest rates, which is something that retirees will be grateful for, that perhaps they can withdraw to a greater extent from their accounts without entirely depleting their accounts. And retirees are in a tougher spot than they were the last time we saw meaningful inflation in the 1970s and early 1980s. And that's because the good news is they're living longer. So your money needs to last longer. And this is another factor that's contributing to the fact that many people need to keep working in order to give themselves that cushion and buffer in order to be comfortable to have enough of income set up so that when they retire, they will be able to enjoy their retirement. Now, thinking of this moment in time, from a purely economic point of view, it is not a good time to retire. That's from an advisor over at Allianz Investment Management. So those who can continue to work, many of them probably will and possibly should, but yet retirement is never purely a financial decision. Many folks would like to be able to get out and travel and do things while they're still physically able to do those things. So you have to weigh and balance those factors with the current environment and make the best personal decision for you and your family. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. This podcast is available on most platforms, including Apple Podcasts, Spotify, and Pandora. For more information, please visit our website at www.heroldlantern.com.
Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.